We moved out of the Ninja Park to the backyard, set up a slack line for the kids. There's some other stuff around that they'll have a chance to play on. But I did want to finish up with the statement of cash flows. The park was a little bit loud and the wind was really starting to cause some real problems. So hopefully it's not too bad for you guys to hear the last video I did. This one should be a lot better. I've compensated a little bit, switched out mics. Anyway, moving on to the statement of cash flows. So we dealt with the balance sheet. Now we're gonna do the statement of cash flows. It might seem unusual at first that we're gonna do the statement of cash flows right after the balance sheet, but the statement of cash flows is almost an extension of the balance sheet. While it reflects flows, but it reflects flows of cash, and cash is reported on the balance sheet. And as you'll see, large portions of the statement of cash flows are derived from the information that we have in the balance sheet. So we'll work through that. This is actually a relatively new statement, only being around for, I don't know, let's say 30 or 40 years, probably 40 some odd years now, in comparison to like an income statement and a balance sheet that have been around for far longer than that. So with the statement of cash flows, starting off with, why do we even have it? This is a relatively recent phenomena that we started disclosing a statement of cash flows. And the idea is that it provides relevant information about the cash receipts and payments of an enterprise during the period. So this came out of some critique of the income statement and this idea of accruals, which is how we get the income statement. The accruals are the goal of accruals is that they're supposed to be a good predictor of future cash flows. Again, the big concern or the big desire is for an understanding of cash flows, not necessarily net income. The idea behind net income is it is a good predictor of future cash flows, whereas historical cash flows are, well, not as good of a predictor of future cash flows. And that's because of a lot of the timing differences that accrual accounting tries to balance out by recognizing revenue when you performed your service obligation, recognizing expenses when in conjunction with those revenues, where we're trying to match things up. Well, cash basically throws all of that out the window and it just says, well, did cash change hands? If yes, then you have a transaction, and if no, then there's no transaction. That's the kind of contrast between what we have income and cash flows. So there's been critique of income over the years. It does provide a lot of judgment. There's some inaccuracies in accruals simply because it requires a fair amount of estimation to develop those, particularly for some businesses. And then there's this idea of, well, if investors are really concerned about cash flows, future cash flows, shouldn't we just tell them what the current cash flows are? Now, with that said, the cash flow statement does provide additional information beyond what we have on just an income statement. It provides information about the cash flows, which helps us answer questions about liquidity, ability to cover debt. Are they generating sufficient cash to continue their operations? Those are important questions to answer. You can have a situation where a company is generating a net income, but at the same time not producing enough cash in order to pay their current obligations. And that creates an illiquid company, which is at risk of going bankrupt, even though they could possibly be reporting an income, at least in that period. Now, that can't go on for very long, but there is some discrepancy there. So the cash flow statement, the statement of cash flows, has been developed in order to help answer some of those additional questions and maybe fill in some of the gaps that the income statement opens up. So it provides relevant information about the cash receipts and payments for the period. It tells us stuff like, where did the cash come from? What was it used for? And generally, we're just explaining the change in the cash balance. That's largely what it does. It provides us some additional useful metrics in terms of ratios. There's the current cash debt coverage ratio, which is just taking the cash provided by operating activities over current liabilities. And that gives us an idea of liquidity. Is there enough cash to pay current liabilities? Now, you can look at total liabilities, which gives us a little bit more of a financial flexibility perspective, which is, well, how much cash do we have to pay all of our liabilities, either now or in the future, or how many periods are we going to need to generate cash in order to pay off our liabilities? And so that gives us a cash debt coverage ratio, which is just the cash provided by operating activities over total liabilities. So those are some useful ratios in general. I'm not super concerned that you memorize lots of ratios. Regardless of what you end up doing, you're going to tailor ratios that help answer your questions. So if If you were to go become an auditor, you're going to learn different ratios than if you were to become a financial analyst. And that's going to change whether you're doing credit or whether you're doing equity. And for equity, it's going to be different based on whether you're buy side or sell side. The ratios that you use on a daily basis are going to change, and you're going to need to learn those more so than just some canned ratios that you pick up in finance or accounting class as you move through your college career. So that brings us to what the content of the cash flow statement is. The cash flow statement is divided into 3 sections: the operating activities, investing activities, and financing activities. Those are the 3 sections of the cash flow statement. Starting with operating activities, this provides cash effects of transactions that enter into the determination of net income. So in conjunction with that, as you'll see when we start preparing the cash flow statement, we start that by basically reconciling net income to cash provided by operations. And that tells us, it provides us the closest measure of net income that we have for cash. And that provides us, is the company's operations generating sufficient cash to do whatever they want to do, whether it's grow, whether it's pay off debt or other liabilities. That is the most similar metric to net income. So operating activities or cash flow from operating activities and net income kind of line up to try to answer the same question from 2 different angles. Now that's operating activities. Next, we'll move on to cash flow from investing activities. Cash from investing activities. Investing activities are investments the company makes. Now these can be what we think of typically as investments, like investing in stocks and bonds, but more frequently, this is investments in the company itself. So the company or management, they have this bulk of resources or bulk of capital that they've been given. How are they investing that to generate cash flows in the future? Now, the biggest piece of that is buying assets to use in the company. So for instance, they will buy long-term property, plant, and equipment or land to use in the company to generate future cash flows. Those are investing activities in the sense that they're not necessarily specifically operations, but that is how the company is using the capital provided by the investors in terms of a long-term perspective. Now, the last section is financing activities. So we have operating activities, investing activities, and now financing activities. Financing activities are the cash flows, inflows and outflows that affect liabilities and owners' equity items. So if the company borrows money and issues long-term bonds, that's a financing activity. If they sell stock, that's a financing activity. If they pay dividends, that's a financing activity. So those financing activities go into the cash flow statement as financing activities. And the idea is those are very different than cash flows from operations. We wouldn't want to lump all these together because then we wouldn't be able to know is the company's operations providing cash flows? That's what our goal is. If the company is cash flowing merely because they keep issuing stock, well, that's problematic. And it may reveal some weaknesses in the operations or in the strategy that the company's trying to implement in order to generate future cash flows. So those are our 3 sections: operating, investing, and financing. That's pretty critical. Without knowing the sections, we're not even going to be able to start preparing the cash flow, the statement of cash flows. So now let's move on to the actual preparation of the statement of cash flows. Here is a disclaimer. Preparing the statement of cash flows is incredibly difficult. I cannot underestimate the difficulty that people run into preparing a statement of cash flows. With that said, moving on to the preparation of the statement of cash flows. So the information we need a comparative balance sheet. That means last year and this year, or last period and this period if we're dealing with something other than a year. So that gives us our comparative balance sheet. Then we need a current income statement. That's pretty straightforward, but we only need this current period's income statement because it shows us the flows from the beginning to the ending balance sheet. And then there is other select transaction data that we need. So we need asset purchases and disposals. For instance, we need any kind of issuances or redemptions of long-term debt transactions. And we also need any kind of cash equity transactions, whether that's issuing and retiring debt, buying treasury stock, issuing dividends. Those equity and debt cash transactions we also need information on. So with that information, we can prepare a statement of cash flows. So quick overview of how we go through this. We're going to start by determining the cash provided by operating activities. We're then going to move on to investing activities, then financing activities, and then lastly, we're going to reconcile the change in cash with the beginning and ending cash balances as reported on the balance sheets. That walks us through the whole process. I'll provide you and show you what the statement of cash flows look like for Tesla. It follows the same structure that we just walked through. Now, granted, it is far more complex. Tesla is a far more complex organization with lots and lots of different ways cash comes in and goes out. Companies oftentimes disclose what you would consider a very detailed statement of cash flows. And that's so that investors can pick things apart more easily. It's harder to summarize cash flow as it is in an income statement. So if you were to compare Tesla's cash flow statement to their income statement or their balance sheet and do the same thing, say for Walmart, you would see their cash flow statement has a lot more line items on it than their income statement does. And that's very common because there's a lot of different things that are impacting cash that the company wants to be pretty forthright in what's causing that. And that might be because some of those they don't expect to continue in the future. And they don't want investors to think, oh, they're going to run out of cash when, well, this was a one-off item, or we don't expect this to continue. Investors often know that, these, especially the analysts, frankly, it's their job to figure that kind of stuff out. So they want to make it as detailed as possible for those reasons. So this is what you would see if you opened up Tesla's financial statements and pulled their cash flow statement. You would see this right here. Cash flows are reported for 3 years in public company financial statements, just like the income statement, which is 3 years as well. So with that, that wraps up the idea behind the cash flow statement, the information, the uses, what it broadly is. But in the next segment, we will walk through step by step how to actually prepare the cash flow statement. So with that, I'm going to run around here for a little bit, and then I'll be back in a second to finish up this segment with the discussion of preparing the cash flow statement.